Hey, what's going on, everybody? It's me, Rags to Riches, back again, making some more content for you guys here on the 8th of June. As you guys can tell, it's been a little bit since I've last spoken with you. The intention for that is that, well, very busy with work. 6 months straight, I had grinded it out for about 16 to 18 hours daily at my W 2 job. Eventually said, fuck that, I'm taking a week off, so that's what I just did. We were heading towards the later half of it, and I realized in my week of contemplation and thought pondering about life, liberty, and the pursuit of happiness that I hadn't been making a lot of YouTube content for any of you guys who've been following me. So I want to give you a quick update today on the portfolio, go through a few articles that I thought were interesting, and really just to shoot the shit, riff the raff, talk a little bit, just to brush off the old YouTube fiber muscles and things along those lines. If we're on the same page about that and that sounds like a plan, perfect. I'm looking forward to it, and I hope you enjoy the content as well. One more thing before we do get into it as well. Be sure if you have any questions, as I am studying for my CFP right now, to let me know in the comments. My goal as a fiduciary in training is to be able to give you guys information that is not only pertinent and relevant for your individual personal life, but just more so from an educational standpoint. While nothing in this video can be misinterpreted as financial advice or actions that should be taken for your own portfolio, given I'm not sitting with you, you're not my client, you're not paying me fees to provide you advice. What I can say is that by sharing what I'm doing personally with my own balance sheet, maybe this can give you some insights as to how you can further bolster your own returns and do things along those lines, right? Cool. So, as you can tell, if I can pull this up, I have been a busy bee over the past week. One of the things that I did on my PTO was I actually did a deep dive portfolio analysis, set target asset allocations for each asset class I want to start investing in, and then actually created a financial model for how to allocate that capital based on the asset allocations that I'm targeting. If you guys can see here, there's a number of graphs on this chart. Maybe taking it one at a time. This is going to be the broad asset allocation. As you guys can tell, it goes through the different asset classes that I'm targeting, core equities, thematic growth equities, Bitcoin, dividend paying equities, fixed income options, commodities, and precious metals, cash, and these are typically short-term instruments like money market funds and treasuries, altcoins, private credit, more private credit, art, wine, fixed annuities, cash, private equity, venture, and more cash, because cash is not trash in today's rate environment where you can get paid actual money for having your deposits at a fintech, not a bank, because they don't pay you anything. Now, getting into the asset allocation, I'm trying to build out this portfolio to meet the target allocations that I have here. So my intention is to have 15% of the portfolio be within broad market diversified ETFs and mutual funds representing the US and international equity markets. These are going to make up a core of the portfolio and provide uncorrelated long-term capital appreciation for my monies. Secondarily, I do think that there are some larger long-term secular trends that are going to continue to create disruption within the broader economy. Think things like nuclear power, autonomous and electric vehicles, 5G, nuclear power technology. And things along those lines, I think, will provide a additional ballast for growth, which is why this is in the portfolio. Bitcoin, very self-explanatory for anyone who has done even an ounce of research into the space. I like to think of Bitcoin as the hardest money on planet Earth. It cannot be debased, it cannot be inflated. There is no centralized party that controls its monetary policy. There's 21 Bitcoin that are ever going to be in existence, and what someone else is willing to pay you for it is what the value of Bitcoin is. For that reason, I allocate 10% of my portfolio to it. Dividend paying equities I have in my Roth IRA targeting a 10% allocation. We'll get into a breakdown for those holdings in just a little bit, but that is the general idea there. Get some cash flow in retirement. Now, I do think there is a place to use fixed income, options, and commodities and precious metals as diversifying forces in one's portfolio. Of course, when you're a younger individual investor, you have an extremely long time horizon for when you're actually going to need that money. But as a complement to an equity position, those that we just went up through over here, I do have funds in the fixed income, options, commodities, and precious metal space solely to add to diversification and reduce systemic risk across the portfolio. Now, I do have my emergency fund held in the form of cash and cash equivalents. These are generally speaking always going to be held in a single month's worth of reserves in a money market fund, and then a T-bill ladder to make up the difference with additional capital that I have there. Targeting about 5% once the remainder of the portfolio gets built out, but I do need to keep the allocation to about $24,000, as that's what I have targeted for my emergency fund. As you guys know and may possibly hear, since I did get a better microphone, I am a cryptocurrency miner. I mine Ethereum Classic and Zilliqa Apollo miners that I got over from Singapore, and they do produce a sizable portion of passive income that I reinvest. Now, I reinvest those assets into additional cryptocurrencies just for ease of keeping it all on a single platform, and those represent my altcoin portfolio. Now, I do also engage in hard money lending. For anyone who isn't familiar, hard money lending is when a individual trying to get involved into the real estate space can't get a loan from a traditional bank, and they'll go to a private lender, in this case Ground Floor, to get the capital needed for their real estate project. When I say real estate project, generally speaking, I mean either a fix or a flip or a refinance of an existing facility. These are all term loans with a balloon payment. Interest accrues and is paid at a single payment at the end of the loan, and I get to engage in that activity with Ground Floor. We'll get into the alternative asset classes perhaps another day, but I do want to expand the holdings into additional alternative assets like an alternative income fund that Yield Street is allowing, and you don't need to be accredited to invest, art, wine, and fixed annuities. I do have a life insurance policy, but I do think an annuity could be a helpful ballast once I get this portfolio balanced up a little bit. Cash and savings, this is solely for my personal use. Private equity, this is the Destiny Tech 100 that I made a video about last time, trying to get that position size up to about $5,000. Venture capital, this is with Sweater Ventures. For anyone who is unfamiliar with Sweater Ventures, it's a really interesting project. They're a closed-end fund that acts under a interval structure, meaning that you don't need to be accredited to invest in the fund, but they only allow redemptions every periodic basis. I believe they do it semi-annually. The benefit of investing in a closed-end fund with this structure is that, unlike a mutual fund or a closed-end fund you might be able to invest into the public markets, this, because it is semi-private, allows Sweater Ventures to actually invest in late-stage venture capital projects. So a dollar invested into Sweater allows them a dollar to invest into late-stage private equity companies, which then you have an ownership interest in. Venture capital historically has produced pretty sizable long-term returns, especially after the downfall of the 2008 housing crisis. A lot of institutional wealth has been flooding into alternative asset classes to seek uncorrelated returns to the equity markets, and that's a big part of the reason, the thought process why I have these holdings in my portfolio. For a visual representation, you can see here how it's broken out. And then if you go to a consolidated asset allocation view, you're looking at about, what is that? Where's equities? I need to fix that, don't I? Yeah. But anyway, about 35% in equities, then Bitcoin, then private credit, then fixed income, then crypto, private equity, annuities, cash, and all their equivalents, and then options. I think it's a pretty well diversified portfolio. I was running it by ChatGPT, and ChatGPT also does approve. But one of the things that I've been learning while I've been studying for my CFP is that in portfolio construction, about 90% of the returns that you will get from your portfolio are actually going to come from the asset allocation that you select at the time of investments. And the good news for me is that my portfolio returns have been really, really good. I operate under an entity structure. Since tracking data, the portfolio is up about 22.18%, reflected here in this gray line. A lot of this is driven by the recent uptick in volume and prices for cryptocurrency seen at the beginning of the year, as well as the equity markets. The remainder of the portfolio, while not down, is essentially trading sideways, collecting capital in the form of passive income, coupon repayments from the bonds, interest from the money market funds, maturations of the T-bills and the T-bill ladder, and then, of course, the other sources there. And there's a pretty large spread between my portfolio and the benchmarks that I track. Those benchmarks, just for easy reference, are the S&P 500 and the NASDAQ, represented in the blue for the S&P and orange for the NASDAQ. The spread between what my portfolio, the gray, has done and what the benchmarks have done, the blue and orange, is pretty wide. And despite the recent uptick in equity market prices, we've maintained a similar spread. Year to date, we're beating the NASDAQ by about 14.26%, and then the S&P 500 by about 14.1%. And this is really the beauty that I feel about investing in alternative asset classes. When equities do well, they do great, and they should make up the cornerstone of any wealth building journey in any portfolio. But on the other hand, there are aspects to the market which are not in our control. Monetary policy, economic releases, and perhaps it can make sense once you reach a sizable portion or a sizable enough portfolio value to consider investing in alternative asset classes. For a majority of people, this could be as simple as a small exposure to real estate or getting into fixed income if you've only been an equity investor. But if you're trying to normalize and stabilize returns to limit non-systemic risk and to only just have systemic risk in your portfolio, then that's one way to actually do so. I'd rather have many eggs in many buckets than a single egg or all my eggs in one bucket. Does that make sense? So getting into some economic news, now that you can see my portfolio has just been on fire, we do have a few articles that I want to briefly touch on and just give you my high-level thoughts on. From the Associated Press, U.S. economic growth last quarter is revised down from 1.6 rate to 1.3, but the consumer keeps spending. As you can see here, Billy Bob J is working on the truck, and he is pretty good at what he does because he's wearing the black safety gloves, and if I had tried to do that, that Ford F-150 would have caught on fire. Reading the article, the U.S. economy grew at a sluggish 1.3% annual pace from January to March, the weakest quarterly rate since spring of 2022, the government said on Thursday in a downgrade from its previous estimate. Consumer spending rose, but at a slower pace than previously thought, a sign that high interest rates and lingering inflation are pressuring household budgets. The Commerce Department had previously estimated that the nation's gross domestic product, the total output of goods and services, expanded at a rate of 1.6% last quarter. The first 3 quarters of GDP growth marked a sharp slowdown in the vigorous 3.4% rate in the final 3 months of 2023. So, it appears to believe that the Fed's hiking cycle is beginning to have an impact on the wider economy. When I say hiking cycle, for anyone who isn't as deeply involved in the space as I am, what I simply mean is the Fed has influence over interest rates, the cost to borrow on the economy. They've taken steps in the past few years to increase rates to stop people from borrowing as much. When people borrow less, people spend less, and when people spend less, the U.S. economy slows. And that's what we're seeing here. Now, the challenge the Fed is continually going to face is a balancing act between strong growth and weak inflation. Growth, generally speaking, can coincide with a piece of inflation as well. When the economy grows, people are spending more, and people are spending more, prices can go up if there's not adequate supply to absorb their spending. The challenge is, if the Fed raises rates again or holds off on cutting, they're giving not necessarily market participants, but more and more time for something bad to happen into the economy. You have a wave of corporate debt that's about to roll over in the commercial real estate space. You have the U.S. residential housing market essentially in a standstill. You have a whole ecosystem of private equity and private credit players that can't get access to new capital, and they employ a pretty sizable portion of the U.S. population. And then you just have everyday consumers that have extremely high interest rates on their credit cards and other revolving facilities. They cannot afford it if you look at it from a long-term perspective. So it's good to see that the economy is slowing down because it'll give the Fed more of a just cause or ability to cut rates or at least stop their hiking cycle, which they have been tentatively doing for the beginning of the year. But time is going to have to tell on this. In short, the economy is slowing, and you should be a lookout for equities and positions in your portfolio that when they do bad in a bad economy, perhaps those will do the same. Now, getting into an article from CNBC, the U.S. adds a much better than expected 272,000 jobs in May, but the unemployment rate edges up to 4%. Getting into the key points here, non-farm payrolls expanded by 272K for the month, up from 165K in April, and as well ahead of the Dow Jones consensus for 190K. The unemployment rate rose to 4%, the first time it had breached that level since January of 2022, and job gains remain concentrated in healthcare, government, leisure, and hospitality, consistent with recent trends. Average hourly earnings were higher than expected as well, rising 0.4% on the month and 4.1% from a year ago. And I like this chart here, which shows the amount of job creation in the U.S. That's the statistic that is being measured here. The Fed has two primary mandates to put this into context. Number one is going to be stable prices, so they don't want inflation to be hot or too cold, and then maximum employment. Now, when we say maximum employment, you don't mean an unemployment rate of 0%, because there does need to be some movement of employees throughout the economy. What we mean is ideally an unemployment rate of about 2 to 3%, coinciding with an inflation target of, well, used to be 1 to 2, but now it's 2 to 3 because numbers are numbers, and the Fed doesn't actually have a strong mandate. They just do whatever people think would be the best. Now, because unemployment is slowly ticking up, this goes back to my earlier comments that the Fed's hiking cycle is beginning to have an impact. Consumers are spending less than they used to, and then by consequence, companies unable to maintain those profit estimates that they had given out the year before may need to, quote-unquote, batten down the hatches to continue to raise the bottom line. And when that occurs, unemployment is going to spike up as a consequence. Now, what is more important than the national unemployment rate is going to be a state-by-state review of unemployment. The reason for that is there are going to be some parts of the country that are going to be more deeply impacted and can give a leading indication as to where the economy is going, as opposed to looking at a national conglomeration of these averages. Just to give you some ideas of what I mean. Right now, New York City is a hub for finance, has been, always will be, at least from what I can tell. California, on the other hand, is a bastion of tech and innovation and fintechs and startups along those lines. What do we see last year with the tech crisis in California? There is a large uptick in unemployment, and there is a downtick in home prices. Why was that? Because when the big finance tech bros no longer have their 8-figure paychecks, it has a meaningful impact onto the economy, and that then trickles through to national data. So I guess we're going back to the 2008 adage, bad news is good news. So I'm happy to see unemployment went up a little bit compared to our last reading. I do want the Fed cut. Now, as a final thought, I want to talk to you guys briefly about the Bitcoin ETFs. Since being rolled out from a number of institutions, BlackRock's, Grayscale, etc., they've just continued to accumulate an extreme amount of capital from the retail and registered investment advisor space. However, this article did raise an interesting consideration that I hadn't had on my radar yet, but it's pretty logical. And in short, without going into the article, these individuals that are buying the ETF are not necessarily your standard crypto holders. When you think of crypto investors, you think diamond hands, retail, never going to sell, I will die before I sell my Bitcoin. Whereas for asset allocators, every quarter, every 6 months, every 1 year, they're going to do something called a rebalance. And what a rebalance simply means is going to my Excel. I've built out an asset allocation for these asset classes. And then within the asset allocation for core equities, I have a target of 40% out of 15% to go into US large caps. Right now, if I was going to rebalance today, I have over-invested $491 compared to what I have as a plan for the remainder of the portfolio. Anything in yellow here is something that I want to buy more. Not because there's any kind of catalyst or thing going on, because it's a predefined asset allocation that I've set, and any capital has a place where it's supposed to go. There is a plan for the money. And in the same way I have a plan for my ART allocation or my allocation of VET on my Binance portfolio, individual investors who are holders of the Bitcoin ETF are eventually going to be sellers of the Bitcoin ETF. That's not a bad thing. It's just a feature of the market participants that are going to be targeting that ETF. The point that I raise it is only to say that we can expect the Bitcoin ETFs to provide some form of a floor for prices, because it opens up the available pool of consumers to purchase Bitcoin by proxy to the ETF. There is likely going to be support from the bottom for prices moving forward. But that's not to say that these individuals can't sell, and that they could also lead to downturns as well. If BlackRock ends up holding a sizable enough portion of the overall Bitcoin float via their ETF, who is to say that many people selling their shares, redeeming them, isn't going to have to cause them to reduce prices? Anyway, just a little bit of food for thought. On that note, I did want to let you know that I am going to wrap up for today. It's been a pleasure having the chance to speak with you guys. I'm thinking about bringing this video series back up once a week just to chit-chat about the portfolio, make adjustments as needed, go through any kind of market updates or things that are topical or interesting. If that would be good for you guys to see, feel free to like, comment, and subscribe and let me know your thoughts. I would love to engage in a dialogue with you guys. Always happy to do live conversations too, over a Zoom or over a podcast. If any financial influencer or individual wants to talk about the markets, shoot the shit, and just like chit chat about the broader economy, happy to do so. I do this as a passion and a hobby, and if I can share some information with you guys that would be helpful, then it'd be very glad and a great opportunity for me to do so. On that note, today is Saturday. It is 10:04 in the morning. I want you to get a cup of coffee, have your favorite adult beverage, spend some time with family, and if you don't have them nearby you, do something that you find enjoyable. I plan on watching a movie series called The Maze Runner. Hadn't seen that since 2010, but hey, I got some time, so may as well do that. And then tomorrow, be hitting the books, maybe make another video, and I guess I'll be back to you guys when the time is right. Have a great day. Thank you for being the best part of YouTube, and turn those rags into riches. I will see y'all later.